Hi, I'm Samir Jain at Active Allocator. Wednesday 14th, oil prices plunge as oversupply prompts a steep sell-off. This is the Wall Street Journal. So from an asset allocation perspective, how should we respond here? Our research tells us that while the relationship with oil price is strong in the long run and other energy assets, many energy assets do not display as much correlation as one would ordinarily suspect. So, in my view, there are at least three reasons why the observed correlation in the data appears to be lower than what would one intuitively expect. First, not all energy companies are created equal. Oil and gas drillers, service companies, as well as upstream oil and gas explorers clearly have the highest exposure to oil prices, while midstream companies that are, think of them as those that are involved in distribution, have a lower exposure. And the glut in the United States has not reduced the demand for storage or transportation, and many midstream companies have multi-year contracts that guarantee an annual minimum payment. Moreover, downstream oil and gas refining and marketing companies tend to have a negative exposure to oil prices, except of course during recession, because their profit is related to another metric, which is called, for those of us who follow markets, the crack spread. So private owners who have leased out exploration rights to oil and gas explorers, these guys may receive cash bonuses besides royalty payments, which reduce their exposure to oil prices. Second, long-term expectations of oil prices instead of short-term fluctuations of spot prices has a larger impact on most energy companies. And this is because a company's value is the sum of discounted future cash flows. And many energy companies have oil reserves that last for decades. So the market expectation of long-term supply and demand of oil drives energy companies' valuation. Besides, oil-producing companies use futures and options to hedge the oil price exposure of part of their production for the current year and often for the next year. The third thing is the valuation of private companies is often not marked to market, and their price moves do not fully reflect changing market conditions. For example, the sensitivity of an oil explorer to oil price depends on the recycle ratio, on the financial leverage. So from a hedging perspective, our suggestions on hedging oil price risk is that, of course, naturally we advise clients who already have significant exposure to oil to not invest in oil producing or service companies. And such clients should also avoid alternative energy companies and industrial machinery companies, as these have a positive exposure to oil prices as well. Furthermore, I think it's a good idea to reduce oil price risk. So things that make sense are to invest, if one must, in oil and gas refining and marketing companies. And gas price, we know, is stickier than crude oil price. So when the crude price drops, gas prices do not drop as much. And as a result, the crack spread increases and refiners tend to have higher profit margins when oil prices drop, as they have this week. So one can invest in consumer staples, aerospace, defense companies, airlines, and many other industries that are less correlated with oil price drops. Amongst the non-energy industries, consumer staple has the highest negative correlation with oil prices. And for tactical bets, we also suggest ways to hedge oil price exposure with futures or put options. Which brings me now to the second piece of this talk. The IEA has just released its World Energy Outlook. For those of you who invest in or track energy, this is an absolute must read. It's pretty dense, but it says that the solar and wind energy costs have fallen dramatically over the last 5 years. There are global risks in oil and gas supply. Emissions are rising, and climate change goals are just not getting met. It also says that rising incomes and growth in population are going to increase energy demand, which is intuitive. And most of the demand and naturally, therefore, investments are going to be directed to Asia. The US will supply over 20% of global oil and gas, and we know that's thanks in part to the shale revolution. And it's going to be all about electricity. Electric cars, electric distribution, electric heating, electricity access will double the demand in the next 2 decades. Sadly, despite this, over 5 to 700 billion people in the world still won't have access to electricity after 2 decades. And electricity is already 20% of the global energy mix. And there are going to be huge investments in infrastructure upgradation, and all of these are needed in developed countries. Consumption too is going to double and increase in developing countries. But what stood out for me was they say that solar installed capacity will exceed wind before 2025, hydropower in 2030, and coal before 2040. Another metric that jumped out was nuclear power is around 10% of this energy mix, and China is going to become the world's largest nuclear power nation. Oil use for cars is going to peak, and most of the new demand for oil is going to come from petrochemicals. Coal is going to give way to natural gas, especially for industrial usage. And trade in LNG, of course, is going to increase, in fact, double, especially given China's demand. Carbon dioxide emissions are out of control and are really the biggest driver of climate change for those of us, and I happen to believe in it. They have a great section, in fact, in their report on climate change. They stress, and this shouldn't come as a surprise, that government needs to play a much bigger role to bring in cleaner energy. So from an asset allocation perspective, I wouldn't read too much in today's Wall Street's screaming headlines, but think about investing in energy from a much larger perspective, at least from a strategic asset allocation point of view. Thank you so much for listening in. Bye-bye.